Julia, let's just start from you. What are you expecting on the market today? We have opened in the red, of course, offshore markets weaker overnight.
We should see some good volumes going through the market today. Today is the expiration of index derivatives, and that usually helps to boost the volume side of things. But the biggest story overnight is the fall that we saw in treasuries, and we're really starting to see some re-risking in terms of the treasury market. So if we have a look at treasuries, a big fall there, and also commodity prices. We saw gold prices down by about 3%, silver prices down by more than 4%. We also saw oil prices down by 1.2%. So our mining sector looking to come under a fair bit of pressure today. In terms of economic news, we'll be watching that RBA bulletin, the quarterly bulletin coming out today for any signals in terms of interest rates. But altogether, we are expecting to see a weaker day on the Australian share market, despite US stocks really not doing too much. And that's really because of the lead that we got from commodity prices overnight. I think it's a positive for Fortescue. Its capital expenditure is rising, and it should continue to accelerate into the second half of the year. We should see capital expenditure costs really peaking in around about September this year before coming back down. And that's, of course, as Fortescue tries to ramp up to 155 million tonnes per annum by June 2013. If we have a look at Fortescue, last week we saw an extremely positive announcement coming through from Standard & Poor's, and that is an upgrade of its credit profile to BB-. That means cheaper costs, and we have certainly seen that flowing into the yields that it's paying. Back in October, it did a raising, and it paid 8.25% in terms of the coupon. But this time around, it's paying 6% for the 5 years and 6.825% for the 10 years. So altogether, the funding costs coming down. The size of it has increased from $1 billion to $2 billion. And I think yesterday when Fortescue came out with that $1 billion amount, there was a little bit of surprise at the small nature of that amount, because just the mining fleet alone should cost around about $1.6 billion. So that $2 billion probably more in line with what the market was expecting. But Fortescue, when it does start to ramp up to those 155 million tonnes per annum levels, you can expect another credit upgrade come through from those ratings agencies, as long as iron ore prices remain stable and its cost of funding should continue to fall.
Julia, I just guess that continued demand for iron ore, we are expecting the big miners BHP and Rio to just reveal a little bit in the coming week at some of those conferences in relation to iron ore. All in all, do you think that there's a story emerging that perhaps China's demand is falling, but they're still going to be buying as much, maybe stockpiling? What would that send a sign in terms of China's economy to not only investors here locally, but to investors around the world?
I mean, there's a reason why we have seen weakness in BHP and Rio Tinto's share price. I mean, the share prices are still down more than 20% from 52 weeks ago. And the reason for that is the market is trying to balance up the long-term story, which is extremely bullish around the industrialization of China and India, against the short and the medium-term impacts coming through in terms of demand. If we have a look at what iron ore is primarily used for, it's steel production. And if we have a look at what steel demand has been driven by, it's been driven by construction out of China. Now, we know that story is softening, and indications from steel companies have been a softer demand picture as well. We've seen China still coming out to negotiate lower steel prices with Vale and trying to renegotiate lower prices with BHP and Rio Tinto, so far unsuccessfully. So it is something that we are watching very closely. We've seen China this year reducing its growth forecast from 8% to 7.5%. The comments coming through in the last 24 hours certainly not helping the commodity space or the Chinese Shanghai Composite, which was down around about that 1% mark yesterday. So that mining space, one that's going to be hit hard today, and one that we're going to keep a close eye on, because if we have a look at a key driver of this space, it's not only China, but it's really the Chinese construction market, and that's where you want to start to see some growth coming in before these miners really see some upside.
The first half numbers slightly below expectations. Why, or where rather, has the main downward pressure surprised?
Well, if we have a look at Myer, no surprises here that we are seeing a difficult retail environment. We did see net profit down by 18% to $88 million. This was only slightly below our expectations. Our expectations stood at $89.4 million. And in fact, the dividend amount has come ahead of our expectations of 9 cents. While there are a lot of negatives in terms of the retailing sector, if I can just focus on some of the positives coming out of this announcement today, I think there was an expectation that perhaps full-year earnings guidance was at risk. It stands at about $100 $146 million. And a positive today is that Myer has come out to reiterate that full-year guidance that it will be no more than 10% lower than FY11. So still standing around that $146 million mark. So a tick there because there were some expectations of a downgrade. In terms of sale guidance, flat at the best, so no surprises there. But we have seen some commentary around the improvement that we've seen from the first quarter to the second quarter. We were expecting to see second quarter like-for-like sales down by 2.2%. It has come in slightly above our expectations. Like-for-like sales actually decreasing by 1.7%. So we know that there is a weak retailing environment, but the valuation of Myer as well as the dividend of Myer should help to support prices around these levels. Of course, it is undergoing those structural changes. The online strategy is going to be very closely watched today to see whether we get some sort of insight into how Myer's going to make some inroads there. But altogether, this result slightly below our expectations. The dividend actually coming in above our expectations. Second quarter like-for-like sales coming in above expectations, and the fact that they left guidance unchanged should be a positive. So we are seeing a little bit of a lift in Myer shares today, up by 0.8% or 2 cents.